started.
Hello, everyone, and welcome to the Adjusted for Risk podcast from the shores of Lake Tahoe. I'm really excited for today's episode that includes two fantastic guests who will be making their second appearance on the show, which is a good sign we didn't scare them away after the first show. And considering how fun the first appearance was, I'm very confident this one will be entertaining and very informative. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So I'd like to welcome Landon Jones and Ethan Dunbar of Revisor back on the show. Landon is the founder and president of Revisor, while Ethan is the chief investment officer. This is sure to be a very engaging conversation and one that I'm excited for, as I know I'm going to learn a lot, as both Landon and Ethan have a wealth of knowledge regarding portfolio and investment management. And I want to get their take on the state of the economy and markets as we head into the second half of 2023. So with that, I'm going to stop talking. Let's turn it over to the stars of the show, Landon and Ethan. So guys, thank you so much for coming on the show again. I really appreciate it. So let's get started. Ethan, is it safe to say the recession concerns are behind us? Did we make too much about a potential recession? Or is it still too soon to signal all clear ahead?
Yeah, first of all, thanks for having us on again. It's a pleasure. Had a blast last time, but I'm sure we'll have fun again this time. For me, the recession concerns, it's hard to say that recession concerns are past us. That's, economists remain split on that. And here at Revisor, we remain split on that as well. We could see an economic recession materialize in the second half of this year. We've been calling for a Q3 or Q4 indicated recession of some sort for a time. But whether that actually materializes or not, is difficult to say. I think most people, when they ask that question, at least from our perspective, they're asking, well, is that going to impact my portfolio? And my typical response to that is something along the lines of, well, yes, but we've already felt a lot of that in the sell-off of last year. We have to remember that markets, stock markets especially, but both stock and bond markets are forward-looking. And they're looking out somewhere between 12 and 24 months. So even if we do enter an official economic recession, will it, there's a good chance that stocks look past that into 2024 and beyond. That doesn't mean that doesn't hurt the average American if they continue to struggle with making ends meet. But from a portfolio value perspective, I think, we have to remember that we're looking past the next 12 months.
It's interesting. Like you said, equity markets are forward looking. A lot of times they price in, whether the Fed is going to cut rates or increase rates or potential recession. Do you think then that maybe equities have priced in a potential recession and that's why they've had such a fantastic run this year so far?
I personally do. I think equities have been priced. We've certainly been in an earnings recession for some time now. And I think that equities have been pricing in or discounting the likely possibility of an economic recession as well. And I do think that that's been a modest recession has been priced into most equity prices.
Interesting. Great. So Landon, you're at Revisor, you have clients that are both financial advisors and private clients. What are you hearing from financial advisors or your clients? Are they concerned about a potential recession or are they, more optimistic?
Definitely concerned. Yeah, everybody's concerned. It's such an interesting thing because none of us know for positive, right? So it becomes this issue of, well, I don't know for sure. So what does that mean, in regards to what do we do with your portfolio? And what I'm finding is, I don't know that it's a perfect solution, but essentially, especially from the financial advisor side, they're looking for ways to create that kind of Ray Dalio, Bridgewater, all-weather type of type of approach in their portfolios, especially in times like this where people are a little skittish. So they're definitely concerned, and there's questions coming up all the time, really revolving around things like adding private equity and just your typical alternatives to a portfolio. Does it make sense? Does it really work? So on and so forth. But to answer your question specifically, yes, on both the individual client side and the financial advisor side, everybody's concerned about it because it feels like it's looming, and we don't know for sure, but it's looming out there and feels like there's a high potentiality for it. But unfortunately, we don't have that crystal ball, right?
Yeah, if we had that crystal ball, we'd all be on the beach, right, drinking umbrella drinks or something like that.
Yes.
That's great.
It wouldn't be any fun anymore if we already knew, what would we do? What would we do with all of it?
I know it'd be too easy, and nobody would need people like we're right. Like, need it more difficult. The other topic, everyone's been talking about recession. Is it coming? Is it not? But inflation, and we just received June CPI data. Inflation continues to trend downward. The headline inflation came in at 3%, which is lower than expected. While inflation continues to cool, prices still remain above the Fed's 2% target. Do you think we will see inflation reaching 2% anytime soon? And if so, how much more work does the Fed have to do to get there?
Yeah, that's a really, really good question. We did see, we've had a couple of months of better than expected inflation numbers, which is great, right? I think that a lot of market participants are still discounting just how sticky inflation can and has been. And it's easy to get excited over the good news, but and this is part of the reason why we say that the recession concerns are not beyond us, and we don't know exactly how severe it could be, which is brings some of the uncertainty back into play. But I do think that the Fed will likely they'll likely raise rates one more time, and I think that at the moment we'll have to have an extended period of a pause before they cut rates again. And I think there's a lot of optimism about the Fed potentially cutting rates later in this year and being more aggressive with being less restrictive in their monetary policy decisions. But I do think that we've got a little bit more of a ways to go, and some of the inflation that's sticking around here is more sticky than most people are giving it credit for. That's my personal take on it, at least.
Yeah, I agree. It's been a great 12-month trend of inflation falling from a year ago over 9%, right? So we're trending in the right direction. It feels that this last 1% to try and get down the 2% target is going to be a little bit more difficult and time consuming than what some people believe. And we were talking before we went live about just how expensive it is, groceries, and especially up here in Tahoe. We're kind of an outlier up here, but when it comes to recession, and this is a very unscientific view, but when I see how many people are in Tahoe waiting in line to go to the restaurants, how many people are at the beach, that it doesn't look like there's a recession in sight, or people aren't feeling pain. They're continuing to spend, and high prices aren't, they're not concerned about them. But again, we're a little bit, outside the norm up here in the destination city. But, equities, you mentioned, we've talked a little bit about equities. They've had a fantastic first half of 2023. We're near a bull market territory from 2022 lows. Can we expect more of the same during the second half of 2023? Or do you think investors should, cool their expectations and kind of rein it down back and not get over their ski tips?
Yeah, from our perspective, I look at, we've had the first half of this year, the first 6 months, the top 7 stocks in the S&P 500 have accounted for almost 80% of the total return from that index, which is not common. It's usually more. It's not that it never happens, but it's usually more of a broader rally. And from our perspective, I think we really have two potential outcomes. Either we have worse than expected, more bearish news, and those top stocks have to compress their multiples a bit. Or we have continued good news like we got this morning from the inflation numbers, or maybe even better than expected news that's more of a bullish signal. And in that case, I think we see the rally broaden out, and that would be a more healthy market, in my opinion, a safer market. That's where we're trying to, where possible, encourage investors to remember that and not get on the coattails of buying into those top 5 to 7 names too heavily, and try to diversify into a more broadly diversified positioning with the rest of the market. Because I think in either outcome, you're in a situation where you're better off in the next 6 to 12 months with a more broadly diversified portfolio instead of trying to focus too much on those. I would be personally surprised if we saw the major run up that we saw again, if we had a duplicate of the first 6 months in the second 6 months. That's not to say I don't think we could have positive returns, but I think we have to see the rally broaden out a bit more, and that's the more likely outcome at this point.
Yeah, I've kind of mentioned that the concentration of high returns, or in those seven, the magnificent seven, to me that's a risk for the overall market. If the Fed surprises and there is bad news, those 7 names, they could sell off quick, and we kind of saw that last year. We could have a steep sell-off, and that could really bring down the entire market, especially when it's almost 30% of the S&P 500 is concentrated in those 7 names or in technology, which to me is a big risk. If there is a surprise somewhere in Fed, who knows, maybe they will raise rates a couple more times and cause chaos. But it would be nice to have, I'm not a technical investor, more fundamental, but more breadth of the market, moving forward.
Yeah, that concentration risk is certainly elevated right now. It's something to pay close attention to.
Mm-hmm. But it also, gives some opportunities, like you said, Ethan. Some other sectors, such as maybe materials or some of your more cyclical sectors or value oriented, there could be some opportunities there. So, you mentioned 80%, nearly 80% of the year-to-date returns are due to technology stocks, or even those magnificent 7. And you mentioned, will it continue to carry the market performance, or will there be different equity sectors that lead the way during the second half of 2023? Right.
Yeah, and that's what I if I had to bet on it, which I guess we all have to do if we're in equity, if we're investors, right? We all have to take a bet one way or another. It would be that there's some different leadership in the second half for the next 6 to 12 months. There's some different leadership that's more of a value play than the tech and growth play. So seeing some other sectors lead the way, seeing some other styles like value do better in the second half of this year and into the first part of 2024 is something that I think likely. And it's good to remember that a lot of the kind of bounce in the tech stocks is coming off of an abysmal year last year. So there's some just natural price recovery that occurred in those markets as well. So not to forget about that.
Yeah, it's really like a rotation trade from last year, right? If you look at one of those quilt or periodic table graphs, it's like a complete flip from last year, where last year was more the value names. Now its growth has outperformed this year. So it'll be interesting to see how it plays out in 2023 with, when we often talk, Ethan, you probably look at this, valuations, those value, the overall market, the S&P 500, it's not that overly valued. When you look at historical measures, it's a little bit higher in terms of forward PE ratio, but it's really driven more by those growth names, the tech sector. The value sectors are attractively priced right now, and they're not that. When you look at valuations, they're somewhat attractive.
Not as expensive as it seems. Yeah. And if you look at like an S&P 500 equal weighted, you can see that very clearly, that the prices that we're paying right now for if you if you do some method of excluding those top 5 to 7 names, the prices look much more attractive. So it's an encouraging thing for investors, at least in equities at the moment.
Very interesting. So everything looks good. We think risks, though, risks always remain that wall of worry. Monetary policies, they remain the primary driver of market performance, but there's always that risk that the Fed is going to screw something up. And a lot of people over the past couple of years think they already have screwed something up. But we also have geopolitical risk. And, like we talked about, highly concentrated indexes. What are your biggest risks for the second half? And what are you telling your clients? Let's start with you, Landon. What are you telling your clients in terms of risks moving forward?
Yeah, so it's interesting when you all were, as you and Ethan were kind of having dialogue there, I kept having this thought of like, this market just seems like it just can't be, like it can't be broken. It doesn't matter what we throw at it. You got the Silicon Valley Bank, the banking scenario, what's going on in Russia, Ukraine, and all of this stuff that seems like it's got the potential to cause really, really significant downward movement, inflation numbers and everything else. But it just seems to keep on going, or at least staying the course, no matter, what information comes out into the space. So it's been a really crazy experience for me, to be honest. It's not like I've been doing this for 40 years, but a little over 20 years. I've never seen market like this, without just data, just the feel of things and the resilience of it. But I would say that the client base is definitely, wants to manage risk. And it really comes down to a very similar answer from the last time we were having dialogue 5 minutes ago. But the average client is really just looking for, they have their goals and objectives. They don't want to see significant drawdown on average, with rare exception. And they just are looking for our advice on how to position things to keep everything in line with their expectations. And it doesn't always work out. Obviously, you end up with investors that are obviously more anxious than they want to be and everything else. But we've always got, arrows in the quiver, right? That can take care of anybody's needs. And when somebody makes that shift mentally that they don't want to have that level of risk and volatility anymore, then we move over into safer asset classes. And fortunately it's easy in, this day and age to make those adjustments to a portfolio and really get people in the right domain, get them in the right spot. Yeah.
Ethan, before I pass it on to you, Landon, you made such a good point about markets are just resilient, more resilient now than we've probably ever seen it. Back to the pandemic, we thought the pandemic had that flash crash, very quick recession. Of course, free money, historically low interest rates, and an abundance of liquidity sure helped markets. But we had a fantastic year for markets that year. Last year was a little bit different, but markets continue to be resilient. And what I'm surprised about is the Fed has increased rates at its steepest pace in over 40 years. And basically, trying to bring an end to this, easy money. And it hasn't impacted equities, really. Equities are still hitting, highs and are in a bull market. And I think that's caught a lot of people by surprise. And like you said, Lena, it was like, what's next? What's going to break it? Is anything going to break it? If the Fed, increasing rates to, over 5% is not going to break it, and removing liquidity, what's next? So Ethan, what's your take on risks?
Yeah, there were, there were two things that come to mind that I think are maybe not talked about enough from a risk perspective. More, not necessarily sometimes not necessarily immediately to portfolio values, but just risk to the economy. One of those is that isn't talked about enough is is bankruptcies, especially in small companies right now. We've had a steep rise in the amount of small companies filing for bankruptcy over the last number of months. That's a dangerous metric for anybody, and that could in fact impact portfolio values down the road if that's more severe than is maybe anticipated. I don't think that's talked about enough. The other thing is just the average American they are struggling already. And I think that there's more pressure than maybe most, especially in our space, realize on the average American, because we're fortunate enough, most of our clients that are working with financial advisors are doing pretty well. There's a reason they're hiring a financial advisor. And we forget about that, over half of America makes less than $20 an hour. And there was a recent study that Bloomberg did on a call I was on that just based on the average cost for Americans to pay for a car, a place to live, their groceries, their gasoline, they need to earn $21 an hour in a full-time position. And with half of America making less than that, it's going to be very challenging. And the other thing that, and we have to remember that just because inflation is going down doesn't mean that the prices, we haven't seen deflation. We haven't seen, prices are still elevated. The cost of a new car is very expensive nowadays compared to even just a couple of years ago. And we have in September of this year, we have student loans coming back onto the books for most Americans. And as those student loans come back, I think it's September 1st of 2023 is the number, or is the date. And as that comes back on, that just adds to the more difficult nature of breaking even for a lot of Americans. And the other thing that also is kind of a tertiary effect of that is we haven't seen, there hasn't been punishment for not making student loan payments on credit reports. That will change into 2023, late into 2023 and into 2024, which further reduces the availability of credit to a lot of America. And oftentimes they are using that. And that's an underappreciated risk that I think we forget about sometimes, being in the position we are working with wealthier clients that have savings to hire a financial advisor. But that certainly is a risk to the economy long term.
That's really great point, Ethan. We often forget, when there's a lot of people under $21 an hour, especially when minimum wage is $15 an hour, where gas prices and higher food prices really takes a big chunk of their paycheck, more so than the people in our industry. So that's a very good point, and you're right. It's and then the bankruptcies, a lot of things going on there that we probably don't see or read enough about. So we talked a little bit earlier, you mentioned alternatives and trying to create a portfolio that an all-weather portfolio. How should investors position their portfolios in equities, fixed income, and alternatives moving forward?
They should buy the stuff that's going to go up, Ron. Just buy the stuff that's going to go up.
It seems easy enough, right? Let's end it right there. Mic drop.
No, I'm sorry. I'm making jokes. Ethan, go ahead, please.
No, I think this is, I have some perspectives on this, but I feel like it's such a personal question. And, Landon can, as being a financial advisor for so long, he probably can provide a better, more detailed perspective than me on this, just being a portfolio manager guy. But I feel like it's such a personal decision. And I do think, like within equities right now, I think targeting some dividend growers, some more value oriented positioning is good. Within fixed income, I think we're starting to get to a place where we can consider adding back duration. That was something we took off the table for most of 2022, and we're lucky to do it in time. But starting to add it back now, at least cautiously, is something we're trying to do. But again, the mix between the equity, fixed income, alternatives is such a personal decision. I'd like to hear Landon's opinion on that, having worked so long with people doing that.
Yeah, it's I guess kind of an opinion, but more of like an experiential conversation would be, if you take the average investor loves the idea and the concept of the all-weather type approach, right? But what ends up happening in real life, if the expectations aren't managed well, which is really what it all kind of boils down to for me, is they think that's great when the market's down, right? When equity markets are down, and they're happy that they're, let's say, -10 instead of -25, whatever the case may be. But it flips on it flips when everybody is exuberant and markets are going nuts, and they're looking at their performance report, and they're up 10%, market's up 25. When it goes the opposite direction, it's all of a sudden, you're on the other side of the fence. And so we all have that greed and fear thing going on as investors, and it's hard to find that sweet spot. But what I would say is that in general, even though the investors that get a little frustrated when they're not up as much as, let's say, their neighbor, because they have that more diversified all-weather strategy, they do, with my experience, end up having a better overall long-term experience, as long as they get the proper communication. The advisor is patient and explains to them how all of this works with up capture, down capture, and so on and so forth.
Yeah, we've done a lot of studies here at Zephyr about, capturing less of the downside or preserving your capital, and how that helps, gives you more assets that capture more of that upside, right? So limiting downside losses is very important. You mentioned earlier too, Landon, about alternatives. Are you seeing, and I've went to a conference earlier this year, it was all about alternatives. I've had a lot of guests on talk about alternatives. Are you seeing that more too, where just more and more clients or financial advisors are looking to add alternatives?
Yeah, absolutely. Most definitely. One of the things that, like, we're doing some internal research right now, just on just on that industry as a whole. Because when you say alternative, so I just give you a silly example. This was roughly 10 years ago. I'm trying to blend in some non-correlated, stuff into my, let's say, my satellite sleeve of my clients' portfolios. And I ended up picking this managed futures, this liquid, managed future strategy. It was a 40 Act fund. It was a mutual fund. And what ended up happening was, it didn't perform well. It was a really negative experience overall when you just looked at that one piece to the portfolio. And so I would have to explain that to the client, because they're basically saying, hey, you did this trying to create a positive element in the portfolio. Within like a 3-year time frame, that managed futures position never recovered. It wasn't just a 3-month time frame to wait for recovery. It was 3 or 4 years. And so my point there is just simply, I think a lot of times we take alternatives and you go, well, what are we talking about exactly? We're talking about liquid alts in the form of an ETF or a mutual fund. We're talking about private equity and hedge funds. Where exactly are we going? But overall, I love the concept, kind of the David Swinson, he passed away a couple of years ago, but that mindset of bringing in either lower liquidity assets where you can get a liquidity premium by just simply giving up liquidity, get a little bump in average rate of return if you don't need the liquidity for that part of the portfolio. But anything that can be done that brings that non-correlated feel to the portfolio without significantly reducing return of the entire bucket, right? That to me is the big macro conversation. And we're always looking for those types of strategies to add to portfolios. And I would say clients and advisors, both, not just now, but definitely right now, are asking those questions a lot.
Yeah, it's one of those themes I think is just growing in popularity. You brought some nightmares, about 15, 20 years ago. Remember those 120/80 mutual funds that were all complex and everything, and during the great financial crisis, and everyone kind of was like, well, they didn't work, or I don't know really even if mutual fund asset managers offer those 120 or 110/80 portfolios or mutual funds. But yeah, it was interesting times back then. And now now alternatives are really blowing up, from private credit to, and now you have interval funds and all that stuff. So great. We've got just another minute or two. Any real quick fun stories you guys have heard recently, or that you'd like to share?
Fun stories appropriate for this.
Well, Landon, we'll have to have you guys on for a Zephyr After Dark, or a Adjusted for Risk After Dark, and we'll really get into some fun stories. But
I can't think of any off the top of my head that are appropriate for today. I just had my 45th birthday and 21st wedding anniversary, so one of those interesting time in life. You start realizing, wow, I'm getting really close to that 50 mark. I'm about halfway done if I'm lucky with this whole ride, man. I better.
I'm right there with you, Landon. Ethan, you've probably got a few more years, 10, 15, 20 more years to worry about it. Landon, I'm right there, where every morning you don't do anything the night before, but you wake up sore and aches, and it's like, oh God.
Yeah, that's right.
And it really, when you get to this age and you look at like Tom Brady and some of these athletes that are like 40 years old, it's like you gain so much more respect for them, right? Like at this age, even like 35, like what LeBron is doing, it's like, oh my goodness.
It is, because this machine starts falling apart. It needs oil, it needs WD-40, it needs all this stuff, and it's like, how are these guys doing it?
It's a little bit different playing tennis on the tennis courts now than it was when you were 20.
Yeah, that's right.
So thanks again, Landon and Ethan, for joining the show. It's always a lot of fun, always great catching up. Quickly, where can our audience get more information about Revisor?
On all social media platforms, YouTube, Twitter, LinkedIn, all that great stuff, but also revisorgroup.com web address. Absolutely.
Awesome. Thank you guys, and thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your week.
Thanks, everyone.
Thanks, Ryan. Thanks, everybody. Bye-bye.